Tigerbrands today received approval from the Nigerian SEC to proceed with its proposed 63% stake in Dangote Flour Mills. The acquisition marks Tigerbrands' third in Nigeria and adds weight to its continued Africa expansion. Joining us in studio, Stephen Mainchis from Imara SP Reed. Stephen, thanks very much for your time. Well, this is a big one, and for Tigerbrands going forward, do you believe it is the appropriate kicker for the stock that we may be looking for?
Well, obviously it's going to be long term, but on an EV/EBITDA multiple of about 8.66, I don't think it's necessarily overpaying. I think that's the first thing to determine, and then it's it's a good chunk of one of three companies comprising 85% of the market. So they're in there. I think that's good foothold.
I think what's very interesting, Stephen, is when you look at the market share that Dangote has in Nigeria. And their incredible knowledge of the local market. You know, why you said that the price is fair. Why would they be selling out when you've got 160 million people to feed and they enjoy a market share that's very, very strong there? I think it's in the region of 30 to 40% across the products that they sell.
Well, I think Mr. Dangote himself is exiting. Basically, he's focusing on cement and one or two other areas, and this food and other. A few other industries he's actually exiting, so it's a good opportunity.
Just in terms of the African expansion, I mean, most South African companies, listed South African companies, have this story about Africa expansion and the opportunity to grow into the continent. What does this deal mean for Tigerbrands in your opinion? I mean, they've been articulating an expansion strategy for some time. How should investors view this move for Tigerbrands?
I think business as usual. I think one's really got to watch out for not overpaying, because this Africa thing can get to be a bit of a stampede, and I think it looks as though they haven't overpaid on this one. This is not their first acquisition, so I mean they know their way around. They've been sniffing around for some time, so it looks like, as I say, business as usual. A good one. Nothing necessarily to get excited about, but the strategy is unfolding as it should.
And would this be now a catalyst for you to buy Tigerbrands at this point in your portfolios, or where do you stand on the valuation for the group?
Well, I think it's just positive. Whatever one's attitude was, I think it just enhances that. The whole issue of South African industrials being overpriced is another matter, but in the context of Tigerbrands doing its thing and its strategy, it's good.
Can we also move now to the resources environment, and in the same breath as we say that industrials in South Africa are generally overpriced, many say that resources in South Africa are generally underpriced. Do you buy into that thesis?
Well, yes. At this time, one would normally expect the PEs to be high, anticipating recovery, which they're not. So the PEs are low, which is interesting. And the whole debate on China continues, and everything, the commodity prices, and hang on the speed of that recovery, especially since Europe's in recession and likely to be so for another year. I think that quite a few investors are positioning themselves strongly into resources now in anticipation of that big switch from some of your more highly priced industrials into resources. Our view is that you should have some resources. I mean, the value is there. There's no question about that. So you haven't gotten, you must buy some. But whether to go strongly overweight or not at this point, we think you can wait, actually. The Chinese are taking a lot longer. Indicators, leading indicators, very boring things like the steel price, the iron ore price, and things like that. Until those things turn around, you've probably got time on your side.
You've mentioned quite an interesting aspect around the resources, and that the price, the PE ratios are still very low. I recently went to an insights forum where one of the fund managers talked about only buying the resource counters when the price earnings ratios are very high, because it indicates that future commodity prices may be higher going forward. Where does that leave your thesis on commodity prices, which are obviously such a key input into valuing these companies? Where do you see the commodity prices in the next 5 years?
Well, I see them up, but not just yet. And that's a very good thesis, and that is why the PEs aren't high as of now, because people are very apprehensive. And I think rightly so, because there are a lot of complications in the Chinese economy, and things aren't going to be as simple as they were with the big spending spree on infrastructure 4 years ago.
Just on that note, sorry, Bronwyn, we've heard that a lot of the slowdown in China or the lack of buying of commodities and the use of resources has been dampened somewhat because of the transition in leadership in the Chinese Communist Party, and many people are saying that they expect that cycle to resume once the new leadership has come in place and settled down. Do you have any ideas around what specifically China is expected to do? Do you see this as the sort of GDP growth leveling out at about 5 to 7%? Or do you make an argument, certainly that when you look at resources, that GDP growth may take off again in the future?
Well, I think the leadership transition was a valid concern, but our guess is that there isn't going to be a major change in policy. Certainly we aren't going to have a populist nationalist regime. I think it's more of the same, which is good. The same being, Hu Jintao and Wen Jiabao have been talking re-stimulation solidly for the last 6 months. And it is happening, but just slowly. They cannot go on the big spending spree of 4 years ago. So your question, 5 to 7%, well, the consensus is somewhere around about 7.4 for this year.
I think it'd be a calamity if we suddenly started talking 5% growth, GDP growth in China. But that 7%, perhaps with stability, with the spending coming in on cue, and of course mindful of inflation, pretty stable in that environment?
Well, you know what, it's off a very big base. I mean, you should never forget that. It's a huge base. And so any increase of that level. And then there are obviously micro considerations in particular commodities. Quite a number of the commodities prices have been affected by high-cost marginal Chinese and other Asian producers. Continue to churn out product at a loss. Now they should be terminating production from now on, and that should improve pricing prospects.
Stephen, just in terms of some of the specifics around the resources counters, we hear often that you need to be selective when you choose which resource counters you invest in. At this point, do you favor multi-commodity diversified miners like BHP or Anglo, or do you think that there's an opportunity to buy some of the single commodity mining companies?
Well, I think one can do both. I think one can discriminate a little bit between Anglo and Billiton at this juncture. The diamonds, and you could argue the diamonds and platinum are going to take some time to recover, which gives Billiton the edge because it's heavily into petroleum, which is doing fine. So and then of course the iron ore, copper, and coal are in the same boat. So I think Billiton is perhaps a little bit the one to prefer now. Single commodities, Exxaro won't like me saying this because they aim to be a diversified producer. But right now they've got the iron ore, of course, through Kumba, and they've got coal. And then from now on, basically, the coal production will be increasing as they supply to Medupi. And so that is quite a good one, and that's not expensive at the moment, and the beach sands are doing pretty well.
When you talk about BHP Billiton and its exposure to petroleum or to oil, you're obviously factoring in that the oil price is pretty much at a floor at the moment. You don't anticipate much downside on oil.
Well, so first of all, it hasn't fallen the way other commodities have, so that gives it a bit of an edge. But yes, there are some pretty bearish forecasts around oil, and it's certainly weakened quite sharply the last few days. I don't think we have a particularly strong view on that, other than that it's obviously going to be affected in the short term by the global recession, if you like, or slowdown in growth.
Is it at this point, Stephen, a negative thing to be a diversified miner with a big exposure to South Africa?
You mean with Anglo American? Yes, obviously that's already, but I think that's to a large extent.
And Exxaro to a degree as well.
Yes, well, I don't think Exxaro's, you see, the mining difficulties so far have been mainly deep level, and for understandable reasons, and that means Exxaro is quite possibly not going to be as badly affected as the gold and platinum mines. It's not as though it was ever rated as a global player the way Anglo and Billiton were. So I don't think it's got any de-rating from that point of view. I mean, apart from the fact that price has come off quite a bit lately anyway.
How do you place Sasol, given your view on the oil price? And Sasol's tracking around about 400 Rand at the moment.
Well, I think that if the bearish forecasts of oil in the short term come to pass, it will be an excellent buying opportunity, because the long range, I think, their positioning in gas to liquids is very, very strong, and they can in 3, 4, 5 years time they should be reaping the fruits of their North American investments.
Just in terms of picking apart another South African funded or created venture in the form of Xstrata and Glencore acquisition, what do you think about that acquisition? Which side of the fence would you be on? Is it something that works for Glencore, or is it something that's been very beneficial for Xstrata shareholders?
Well, fortunately, we don't have to take a strong view on that. All I can say is it would be positive from a South African point of view, because I mean, they're two companies with exposure to the country. They don't seem to be divesting from the country. So from that point of view, it would be good. I think when there's been a long drawn out battle for control, I think I would worry more being a Glencore shareholder than being an Xstrata shareholder. In other words, that they may have overpaid.
How do you feel about the mid-tier resource stocks in the current environment? If you move away from the heavyweights, are there opportunities to be had in the mid-tier over the long term if the China story remains steady, as you've pretty much indicated you believe it will?
Yes, there are. Most certainly, we've got some pretty solid candidates there. You've got Assmang, Assor, and ARM. ARM looking perhaps a little bit cheaper than usual. It does have a few platinum mines, and it's got a copper partnership with Vale, which is likely to do pretty well, but that's take a year or two to come on stream. So I think there's pretty solid value there. But clearly, in a market like this, those prices will take the cue from the big boys first.
Just in terms of the one theme that comes across with many of the fund managers I speak to is that, and especially the contrarian value-oriented investment managers, is that platinum has offered a fantastic opportunity to buy at this point, with the labour trouble that we've seen and the possibility that it's been spreading. Just in terms of which platinum companies you'd be thinking offer the most value if you are prepared to invest in that sector at the moment, what would you be saying?
Well, right now, I think Implats has done quite well at a time that was very tough for the industry. Of course, it does have Zimplats, which is extremely profitable. So, and it's already been through, hopefully, the worst of the striking story. So, that's one candidate. And then, Aquarius had a lot of people scratching their heads as to its survival chances. Well, we think it'll survive. So, that's probably a value situation. But clearly, it's going to take time before it starts making money. But we think it'll survive. And if it survives, then it's cheap. But I think a more conventional approach would be, say, Implats.